What are itemized deductions, and how do they save tax? Imagine you're filling out your tax form and wondering if you can lower your bill. There are two main ways to do this. Take the standard deduction or itemize your deductions. Today, we're focusing on itemized deductions and how they can help you save money on your taxes. Itemized deductions are specific expenses allowed by the U.S. tax code that you can subtract from your adjusted gross income. Your adjusted gross income is your total income minus certain adjustments. When you itemize, you list each eligible expense individually instead of taking the standard deduction. If your total of these expenses is higher than the standard deduction, it makes sense to itemize. Common itemized deductions include mortgage interest paid on your primary home or a second home. If you own property and pay mortgage interest, this can be a big deduction. You can also deduct state and local taxes, which include income taxes, sales taxes, and property taxes. However, there is a limit on how much of these taxes you can deduct, which is set at $10,000. Charitable donations to qualified organizations are another major deduction. If you give money or goods to charities, you can deduct the amount you donated. Medical and dental expenses are also deductible if they exceed 7.5% of your adjusted gross income. This includes costs like surgeries, prescriptions, and dental work. In addition, if you suffer losses from federally declared disasters, those casualty and theft losses can be deducted. Gambling losses are deductible but only up to the amount of your gambling winnings. Certain work-related expenses for disabled individuals and some investment-related losses can also qualify. To claim these deductions, you need to file IRS Form 1450 with Schedule A. Keep receipts and records of each expense to prove your claims. Proper documentation is very important because the IRS may ask for proof. For Asian American taxpayers, understanding itemized deductions can be especially helpful. Many own homes, making mortgage interest a significant deduction. State and local taxes can also add up in states with large Asian American communities. Charitable giving is often a part of cultural traditions, so donations can reduce taxable income. Medical costs for families can be high, and itemizing allows you to deduct expenses that go beyond the 7.5% threshold. By carefully tracking these expenses, you might lower your taxable income more than if you just took the standard deduction. This can lead to paying less in taxes overall. But remember, keeping detailed records and receipts takes effort, so weigh the benefits against the work involved. In the end, itemized deductions are a way to subtract certain qualified expenses from your income, which reduces the amount of income that gets taxed. When your total itemized deductions are higher than the standard deduction, it pays to itemize. This is especially true for taxpayers with mortgage interest, significant state and local taxes, charitable contributions, or high medical costs. It's all about making sure you pay the lowest possible tax bill while staying within the rules.